In this module, we're gonna try to discover and identify the trading market and the time frame in which we want to trade in. And this is something quite open, and it comes down to personality and the way of people think differently. So we need to understand and come up with the entry strategies. What are they? And this is something you need to do, and you need to figure that out, which way you want to have your entry strategies done. And you want to also think about your entry price, what sort of entry prices you should be going in and why. So this is something you can write down on the paper and devise your strategy and try to think about it. You also want to think about the trading conditions. So what sort of trading conditions you think are the best to trade and go into and place a trade? So you want to think about that. What are the bases of it? Then you want to think about your exit strategy and your exit price, including now this could be a stop loss. That's also an exit strategy and exit price. So you want to think about that as well. So there are two types of traders. One with a plan and one without a plan. A trade strategy should be very specific. Which should include when to trade, entry price, and exit price. And to do these three things, you have to have four key factors, which are momentum, the pattern, the price, the time. In any trade, you have to do two things. Number one, I first identify the most probable trade, winning trade. Secondly, take acceptable capital risk exposure. So before placing a trade, you want to find the most probable winning trade, because nobody knows what is going to be winning trade. Nobody knows that. But you have to do everything to first identify what do you think is the most probable winning trade is. Secondly, you want to understand that if that trade doesn't go well, your risk exposure is acceptable and affordable. So this is effectively a cycle. When a trade is going bad, you want to close that trade and then again go to the first step and identify again the most probable winning trade, and then of course if you're in profit, you can sell it and then again come to again looking for a new trade with the most probable winning, and if it's not, then you want to sell that trade and then go back to the first step, and you have to repeat this over and over again. This is the cycle which you want to do, and this is where you make the money. To repeat this formula over and over again. First, find the most probable, highest probable winning trade which you think, take it, then you're gonna sell it on profit or whenever you think the stop loss should be, and then go back again and look for a new trade. There are 4 main market perspectives. Number 1, multiple time frame momentum, simple pattern recognition, price reversal targets, and time reversal targets. These rules apply to stocks, ETFs, futures, and forex. There are 2 types of indicators. Number 1, leading indicators. Number 2 is lagging indicators. Leading indicators will prepare you in advance for probable trade condition. Shows you how the current market position relates to past data. Some strategies useful for trading include Elliott wave pattern, Fibonacci price retracements. Now let's look at the multiple time frame momentum strategy. It is also known as MTF. Now it's common knowledge that everyone would agree to trade with the trend. But the issue is how to know the trend direction, and is the trend in early or late stage causing it to reverse. And that's the big question. Trend lines, moving averages, channels, momentum indicators, and other techniques can show a trend on historic data. But none of these techniques can alert you to know a new trend, or if it's in final stage to reverse. So these techniques can only identify an established trend, and usually when the trend has been developed, then it's long way over the optimum entry point is gone, because the trend has been developed. You can see it, it's historical data, and once a trend established, we don't know if it's in the final stages or beginning stages. And when the trend established, we don't know which direction it's going to go in. And then what we need to learn is to identify and understand when the trend is developing, so we can predict the behavior of the trend. We can say that for every trend line, a break indicates a reversal of the trend. But this could be a fake breakout and continues the trend. Using the multiple time frame momentum strategy, we can filter the market for trade direction and trade execution. What is a momentum? So a momentum is indicators, or also called oscillators. Most of them give same information, like open, high, low, and close from a price bar. These indicators have a look back period, which is called a look back period. Different indicators manipulate and display and show you the data differently, but all price-based indicators represent about the same, the rate of change and how fast the price trend is moving. The indicators reversal represent the changes in momentum, the increase and decrease of the rate of change of price trend. That's why you can use most of any price-based indicator for the multiple multiple time frame momentum strategy. So you can use any of the indicators because they're the same. A momentum indicator does not represent a price trend. Price and momentum do not always trend together. For example, a momentum indicator may make a bearish, which is downward, reversal and decline, while a price trend continues to advance. go up. Often both the price and momentum reverse together, but sometimes they change because the price trend is slowing down, forcing the indicator to reverse. We can only make money on price trends. It is possible to trade without using any indicator whatsoever, using only the chart by looking at the time, price, and patterns. Dual time frame momentum strategy. So number one, trade in the direction of large time frame momentum. Number two, trade following the smaller time frame momentum reversal. Now we know that the momentum trend will not always be in the direction of the price different because they can go in different directions, but a good indicator with the right look back period is usually the trend in the direction of the price and reverse within few hours and within few bars of the price reversal. So when the price and momentum go separate, as in the case of bullish price and bearish momentum trend, the larger the time frame, the momentum will keep us from trading because the price trend is slowing down. This is also to limit your losses, and always remember that you will always have losses no matter what you do, but we have to do the best to minimize our losses. Now let's look at the next item. The momentum reversal is when the momentum indicator reverses from, let's say, from bullish to bearish or from bearish to bullish. So when the momentum indicator has two lines, like a stochastic or a relative strength index, it makes momentum reversal when the fast line crosses above or below the slow line. The fast line in most two-line indicators is usually a raw data, and the slow line is usually moving average of the fast line. When the fast line is crossing the slow line, the momentum trend is usually reversing. A momentum crossover is similar to a moving average. A crossover, except the momentum crossover is of the indicator values and not on the price data itself. A momentum reversal for some indicators may be signaled by momentum lines crossing above or below the oversold or overbought areas. There are other indicators which will have other conditions that reflect a reversal in momentum with moving average convergence divergence, which is MACD. I'll repeat that: moving average convergence divergence indicator. I can write that down here. So moving average, convergence, divergence. This is the MACD indicator. So when the bars become taller or shorter or cross the signal line, the momentum speed is changing. Each indicator will have different conditions that the signal a momentum reversal, but all represent about the same thing. The price trend is either reversing, slowing, or speeding up. Most indicators show rate of change, ROC. For example, these are the indicators which show the rate of change, and they could be in stochastic, STOCH. It could be in relative strength index, RSI. It could be in the DT oscillator, DTOSC. Now this is a combination of RSI and stock. So the momentum trend are about the same in all three of these indicators. There are many trading systems out there which sell to you, and they claim that they have a lot of signals and indicators. They are all based on something like this, and these are the biggest ones because the price change calculation, as I mentioned earlier, there's only 4 items which can be happening: open, high, low, and close, and from there the indicators are built. So most of these programs which are selling to you, they are nothing but based on these, and this is something which is also actually free available in the chart program. So if I show you here, you can go to indicators, and they are all here. So I mentioned MACD, that's there, you can add that in. So all of this stuff is already free available, but there are some programs out there which say they have something magical, something special. That's not the case. They are just these indicators, and they trade based on these indicators only. So let's look at the chart to understand the price, momentum, price reversal. So when we look at this chart, we can see that there is a long price upwards, and then it is downwards. But how do we know where the price reverses? It's because when we see few small bars, which is the indicator that the price is now going to reverse. So for example, when we look at this one, we can see that there was a upward trend, and then there was small bars. That means it's trying to force, and the orders are now against the trend that it's following, and then it comes downwards. We can see a similar pattern. For example, here we saw another one that the price went up, and then there was a series of small bars, and then it went down a little bit, but then this was here again repeated, that it actually came down after having gone from reversing here. Then there was a reverse here. So we can see that whenever it wants to reverse, it does a multiple bar right there, and it's the candle is getting shorter. You can also see that, but here the candle is bigger. But again, this wouldn't be a example of the price momentum reversal strategy. If we look at more here, we can clearly see that there was a rise in this price, then there were few bars, smaller bars, and then there was a reversal of the price again. We can see here again that the price went down, a bearish move, then there were few bars, and the price went up again. Then there were few bars, and the price went down again. Here there were not any few bars, so I don't think we can count this one. I don't think we can count this one. So this is an example of the price reversal when there are few bars and then it reverses. This is a downtrend, so here we know that it's clearly going down, so there is no reversal happening here. But when we see that there is a few bars here that reverses a little bit, and then it does go somewhere else, but the reversal is always about few bars. There's few bars there. I'm not sure if it's actually 2. Okay, it seems to be 2 for this price, this 5-minute group. If I change this, it might look different. So the dual time frame momentum strategy is very simple. It's practical and it's logical. So trade in the direction of large time frame momentum, place trade falling smaller time frame momentum, reversal in direction of larger time frame momentum. Which indicator to use for multiple time frame momentum strategy? So you can use the one I mentioned, the DTOSC, because it is a combination of two, which is over here. So combination of the stock and RSI. So you can use this indicator to use the price momentum reversal strategy. And I will show you where this is. I'm going to close. And go here, DT. I think the DT is not available, so you can just put in the stochastic RSI and the RSI itself. Yes. So we've got these two, and you can use the combination of these two to trade with the price momentum, price reversals. Now let's look at the another momentum indicator, MACD. This is the moving average convergence divergence. This is an indicator which is very popular, and it's found in a lot of the trading charts, and a lot of traders use this MACD. I will just show you here. So this measures the difference between two moving averages. And it's shown as a vertical bars, which is called the histogram, and the shorter bars represent loss of momentum. And if a bar is made on the other side of the center, so you can see there's a one dividing point in the middle, and there are bars on the top and the bars at the bottom. And if a bar is made on the other side of the central signal line, this is called a signal line, it means that the faster moving average has crossed above or below the slower moving average. A lot of traders use this, and this based MACD based strategies, and a lot of patterns have developed on top of this. So what is the best settings for an indicator to use? So if I could give you this answer in a quick and easy and definitive answer, what is the best setting for always profits or winning trades, there is no answer for that, because these settings change depending on the markets, change depending on the time frame of that market. It changes every day, and it changes all the time based on the past and future. And it is very unknown what is the best always winning indicating strategy and indicators. It is a constant work, manual and with the help of a computer, to always look at the charts and look at the news to have the highest probability, which is I mentioned here, to always scan the market. To identify the most probable, because there will always be losing trade in the business, because this happens, and then take the acceptable capital risk, and then win or lose that trade, close that trade at a loss or close it at a profit, and then go back to do the same. And the markets change within the time frame. And if anybody is trying to tell you that they have a system whereby it's computerized, or if it's whatever basis they form, it's not true, and it's not possible to predict it, to have any indicator to predict always win situation. It's impossible, and it's never happened before, and it will never happen, because the nature of the market, you can see that it goes up and it goes down, it goes up, it just goes, it's bi-directional. And there isn't a very one simple answer to predict this. There isn't, because it also depends on your stop loss and when do you want to take the profit. If you were to place a trade here and you put your stop loss here, of course you will get the profit here, but then what happens when it goes any lower, and then you lose. In this instance, if you place a trade here and you put the stop loss here, then you lose here. So the size of these waves, they vary, and all we can do is we can use these indicators to predict, and some of the times we are right and some of the times we are wrong. And this is the nature of the business. And there's any other person or system out there saying that they have found a high winning rate, because it's not even possible to have a high winning rate. It's probable that they can have some sort of winning rate, but they cannot say it's 70%, it's 90%, it's 10%. It's not. And this is the problem with trading. I found it over and over. And if anybody is trying to tell you that they have a system where they can make you money, is not true. But the best thing we can do is learn, because when you learn, you earn. So we can see we've learned a lot of things so far in the course, in the module, and this in particular has been a very complicated module, because these indicators are very difficult to understand and they are confusing, and it takes time to practice. The great thing about these indicators is that when these indicators are calculated, they have a look back period in which they have particular time frame, maybe 6 bars or 8 bars, that it goes back, and then it looks back and then creates an indicator and makes a momentum calculation, which are useful for us. These look back periods could be longer, it could be a week, a day. It all depends on your settings. This trade momentum strategy is it's mainly used for a trade setup. It's not meant to be a trade execution where you actually take the trade based on this strategy. This is the first step where you create a matching environment where you set up the trade. In the next module, we will look at how we will execute the trade depending on the course that you're attending. So because the things are complicated. If you consider using this time frame momentum strategy and stick to it, you may be able to trade, have improved your trades dramatically, because it is a very powerful indicator. It's used by a lot of professional traders, and it takes time to develop a habit and understanding of this MACD. I will show you the MACD indicator here. It's available here, so apply, and this is available here. So this is just to show you how things are working. Bollinger Bands, I'm going to delete this, and we have the MACD, which is right here.